Access to money has been tougher with higher interest rates, and so when this happens, more and more people start getting creative with financing options. And one option that's getting more talk lately is the CMHC MLI Select mortgage, which sounds pretty attractive for Toronto real estate investors that don't have much investment capital. The MLI Select says that you can borrow as much as 95% of the value of the home you invest in if it's a multiplex with 5 or more units. They also have lower interest rates, a longer payback period, and with new rules in Toronto where you can convert every house into a fourplex plus a backyard house, making it 5 units, this is definitely catching the eye of many Toronto real estate investors. Now, we think the MLI Select is a great option for some Toronto investors, but practically it's not as good as it sounds for most people, and there could be a better option for you. If you're new here, I'm Samantha Chan from Elevate Realty, and our brokerage wants to help you make smarter real estate investing choices in Toronto. Don't forget to like and subscribe if you enjoy our content. Let's dive into this more. Let me start by explaining what the CMHC MLI Select mortgage is. It's an insured mortgage for multiplexes with 5 or more units. Now, they look at your affordability, energy efficiency, and accessibility. When you upgrade a unit, you can get up to a 95% loan-to-value ratio, meaning you can borrow up to 95% of the property, up to 50 years amortization, meaning you can split it and pay it off in 50 years, and limited recourse, so more protection for you with a commercial mortgage. How it works is you earn points for each category, and depending on how many points you get, that determines the type of mortgage you would qualify for. Now, I'm not going to get into the details of the exact mortgage, but CMHC does have a great guide, and I'll drop the link in the description below. And there's always a but, let me give you the lowdown on how the MLI Select has actually been working. First of all, getting approvals for the MLI Select takes around 6 months, plus another 2 months for design and drawings before you can apply. And if you're super efficient, you might be able to get the design and drawings done during the closing period, but that still means that you haven't applied for the MLI yet. So as you can see, you still have to get a regular residential mortgage, come up with that 20% standard down payment that goes with the residential mortgage, and then start paying for the renovations while you are applying for the MLI Select. And it also looks like recently CMHC might be tightening their rules on refinancing, and you might have to wait up to 24 months before you are allowed to do the refinance, which leads to the next point. You actually need a huge upfront investment with the MLI Select, which is the opposite of what most people think it is. The cheapest route to go would be to improve an existing house, not build a new one. But if you're going for a 4-unit conversion, build a backyard house, and pay for that 20% down payment and closing costs, you'll still need close to $900,000 or more upfront in cash. Plus, it's not a walk in the park. It takes a lot of time and experience to get it done right. Now, let's dig into that 95% loan-to-value ratio a little bit more, and here is the catch. You probably won't actually even hit that because of very strict rent ratio requirements. It's tougher to explain, so let me walk you through an example. Here's a recent project that our client took on. They bought a house in Toronto for $1.05 million, and they're investing $150,000 in renovations to turn it into 3 units. After renovations, current comparables value it at around $1.5 million. So if they refinance that at 80% as a regular residential mortgage, the refinanced mortgage might be $1.2 million. So after renovations, you can pull out almost all of your initial capital, and you are hitting a 100% loan to cost ratio. And by cost, we mean purchase price plus renovations. Now, let's look at another project where you might take on an MLI Select on refinancing. For this, because we need 4 units, we'll need a bigger house, and it might cost a little bit more at $1.2 million. Then we need to convert it into 4 units, $200,000 there, build a backyard house, $400,000 there. So total construction costs would be $600,000. Add that to the purchase price, and we're looking at a total cost plus upgrades of $1.8 million. Now, the potential rents are great. It could likely hit $13,500 per month actually really, really impressive. But even with that, MLI caps the mortgage at $1.9 million because of very strict rent ratios. So if you refinance and crunch the numbers, that actually becomes a 105% LTC. Now, I'm not going to touch on the LTV because the value is very subjective and there's actually not a lot of comparables with 4 units plus a garden suite or a laneway suite in the back. So just comparing apple to apple, LTC for both cases is still pretty accurate. So as you can see, you can borrow 5% more than the smaller project with an MLI Select refinance, but you would need double the money, probably 4 times the time, and you're taking on basically a developer project that's on a completely different level. If you ask us, the MLI Select is a great choice if you're looking to scale your Toronto real estate portfolio very aggressively. Unlike residential mortgages where you're borrowing based on your own ability, which can hold you back eventually once you get more properties and more debt, the MLI is a commercial mortgage, so it doesn't actually work like that. You qualify based on how well your property cash flows, and that's it. The number of properties that you already have won't limit you to buy more investment properties. And the MLI Select also offers limited recourse, which means it gives you more protection than a residential mortgage if you default. With big MLI projects, you will also probably have better rents because you're making more units. And so with better rents, better cash flows, and probably a bigger bump in values too. In a way, you can say it is a better investment because you make more and it's lower risk after you build it. But if your main focus is getting the most out of your limited money and time, then a smaller project with a residential mortgage is still better in our opinion. And because residential mortgages lend you based on market values, if we see more appreciation this coming year, you might even get better LTCs with a residential mortgage in 2024. Just think about it. There's a lot going for Toronto real estate. We're seeing the fastest changes in housing policy ever in Toronto, which is good news if you're looking to build more units. Add that to interest rates likely coming down a bit, and this is going to improve affordability and give more room for Toronto real estate prices to come up a bit. Then we still have a big gap between the growing demand for houses and what's actually available, and this will keep prices and rents strong. As much as big projects do sound very impressive, we still think that smaller ones will be the lower hanging fruit. It has a great balance of less money, less time, less construction risk, and decent returns. The bonus is that we're still in a very buyer-friendly market, so there could be some pretty good deals around. But keep in mind, fixed rates are coming down pretty quickly, dropping over 1% in just weeks. And banks have been revising their interest rate projections down in recent weeks too, so this buyer's market might not actually stick around for as long as we think. If you're ready to explore the best Toronto real estate investing opportunities today, we've got your back. We're not your typical real estate sales brokerage. Instead, we focus on using numbers to make better Toronto real estate investing decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns with value-add renovations and gentrifying areas. So if you want to discuss your private real estate situation with us, just head over to this link to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.